When you're speaking with someone who's sort of new to the game
Sure.
and is considering a purchase, what are some of your kind of like homework assignments that you're giving someone? Our first thing for sure is, where do you want to be and how much do you want to spend? And a lot of times people don't know that first answer, which is major, because I feel like you cannot make a big life decision if you don't know the numbers. And some people have never done a budget before. So what would you say are your kind of recommendations for people to kind of get themselves situated to even evaluate if they're going to make a purchase?
Yeah, 100%. So similar as you, it's like do the simple math around, especially what's your down payment going to be?
Hold up.
Okay, Nicole Arnett here with Doyle Real Estate Group on the Sunshine Coast, and I am so happy to be chatting with Paul Davidescu, private lender, mortgage specialist, finance guru. We've got so many people, Paul, who
Yeah,
are exploring all their options in terms of financing property. We're here in
right.
a rural area. You have all the info in terms of being a lender outside of traditional banking. So we have a lot of questions for you today.
I'm
I'll give a
in
quick
the field though. Thanks for having me, by the way. This is exciting.
thank you for having me. I'm in my pottery studio. Where are you today?
I am in my Kitsilano apartment. Yeah, hanging
Awesome.
out. Yeah. And best part of town, although it doesn't beat the Sunshine Coast.
Well, it's probably a pretty good time. We have lots of beaches each way.
True. We
So
do.
we're good.
We have that in common. We've got lots of beaches. It's great.
Okay. So do you want to tell people like a little bit about what you do first, and then we can kind of dive into some questions that I've got for you?
Yeah, sure. I mean, real quick, I guess first question people usually have is like, well, what's the difference between a mortgage broker and a bank? So generally speaking, as a mortgage broker, obviously there's a lot more selection that you have. I find like, especially even between other mortgage brokers, like the key difference, I think the way we approach things is that beyond giving more selection and being usually more available than, 9 to 5ers, is that like in this day and age, there are so many lenders out there.
Mhm.
And I think specifically, like for people that are self-employed, your income and the way you qualify is treated so differently. So I come from an entrepreneurial background. I've started a couple companies. One went on Dragon's Den. One's a running marketing agency, and somehow I ended up in the mortgage business. But what they all have in common is that they're all very tech-driven companies. So we're very fast on how we get people answers, the way we communicate. It's all about communication. I can't tell you, Nicole, how many deals have fallen last minute because of a lack of communication, or just people getting in their documents a little bit late and the rate shooting up. So we're all about being really tech forward, helping a lot of self-employed people, and especially now, it's so hard to qualify for the mortgage for a mortgage amount that is enough to finance a home that you want. People are always having less than they want. So to maximize your affordability, it's all about the strategy on your down payment, the special lenders you go to. So yes, we actually do work with a couple of banks, but we of course work with some non-bank lenders that some people have never heard about, but they usually beat the banks by like a 0.4%, which over 5 years is 10 grand. Over a whole mortgage period is up to 40 grand. And I sent an article on that too if you want. There's a whole thing around it. So anyways, we have again a lot of selection, but the tech savviness and I think just hustling for people and coming from a self-employed background means we can communicate with people really well, obviously get you a really great rate, but also we kind of understand your world and we do the best to maximize what you can afford. That's always, I think, a really big thing, even beyond getting a slightly lower rate. That's of course something we do, but once you dive more into it, you want to save more money over time, and
Right.
there's more than just rate that applies with that.
Right. And I think that's probably something that so many people miss. It's not advice that's readily available out there. But like you said, saving $40,000 over the lifetime of a mortgage, that's huge. That's an incredible
Yeah,
amount of money
yeah,
with
yeah,
just a small tweak, right? So
yeah.
um, right now, what are you seeing in terms of your typical client, or who's coming at you who is a really good fit for the services you guys are offering?
Sure. Yeah. I mean, the biggest people right now who usually come to a mortgage broker, and let's look at the split right now. It's about 30% of people go to mortgage brokers now, 70% go to their banks. Okay. So most people go to banks mainly out of comfort, right? And convenience. You already have your online banking there. You know the banker for years. Your parents are like, hey, go to Susie the banker. I get it. Like that's the main reason. Really. Beyond that, there's generally not a very good reason because a lot of brokers actually have access to banks, especially Scotia and TD, right? But I mean, yeah, like most cases we see that people are going to their bank probably first actually, and they'll get turned down. Either it's like a flat no, or it'll be like, hey, your credit score is a little bit less than we want it to be at. And usually like even below a 680 now, some banks will say no, or they'll charge you a higher rate, right?
Wow.
So that's, 680 is like not a terrible score, right? So a lot of people also, as alluding to before, they need to afford more. And for example, they might have a townhouse or a home and they have a basement that they want to actually claim rental income on. But unless you make it a self-contained suite, you can't claim rental on that. Although some lenders, and there's one that I can't reveal which one it is, but they actually allowed us to claim rental income on a suite to be. Like the suite wasn't even there yet. So we had to put a construction cost on it. There's a great program called the Purchase Plus Improvements Program where you can actually roll your construction renovations into the mortgage. And then they counted a very generous amount of income on that specific to be rental, I guess, component of the house, which most lenders will say no, unless it's already been there, we're not going to touch it. And then on top of that, some will only take half of the income. Some take 100% of the income. So if you want to scale and eventually have more properties and claim more rental income, there's certain lenders let you scale your income. Because they look at your debt and your income. Your debt will always they always count that at 100%, right? Like the future mortgages and everything you have, but the income, especially from rentals, they'll be selective on that. So yeah, a big thing is we have lenders that are very creative, will maximize your rental income and let you again afford more income, especially if you're self-employed. They take 2 years average, right? And let's say you're an Uber driver now, and that's the thing in Vancouver. Thank God, hallelujah, right? But the issue is that most lenders will only take, they'll need to see you, they have to see you have driven a Uber car for at least 2 years. And that goes back into the bucket of being self-employed, where they'll take an average of the last 2 years, generally speaking. Or actually, it's kind of unfair, but if you made more this year than last year, they average it out, right? If you're self-employed. But if you made less this year, they just take this year, which is, again, most traditional lenders, but certain lenders will, for example, take your Uber income from the last 6 months with discretion, of course. And those end up being more of what we call B lenders or alternative lenders, where, as I was saying before we hit record, is that some of these alternative lenders, I mean, there's a big stigma on how they charge 18% and all these crazy loan shark rates. Some that literally charge 3.60% now, which, the banks were charging 3.74 a year and a half ago, right?
Right. Okay, I'm going to stop you on that because I want to dig a little further into the actual numbers of what those B lenders might charge.
Totally.
So you're saying basically like an ideal client who's looking for some alternative lending might be self-employed. It might not have like a consistent just trajectory of up. I'm getting, a salary every year plus bonus, and there's a raise and a raise. Might be looking to supplement their income with something that is self-driven, like a suite, which is really popular on the coast. So if you were, say, looking to purchase a home that had suite potential, which is huge here, and not as regulated as Vancouver, that lender might look at that and say, yes, there's potential, and here's what we're going to add as a possible income, and that's what you're getting.
Totally. Okay. Yeah, you summarized it very well. You converted my jibber jabber into like a perfect, concise, full sentence. I love it.
Sometimes what realtors do.
Yeah, no kidding.
You got a lot of info though. You have to tell us a lot of stuff. Okay, so then the follow-up to what that ideal client would look like. What would be the difference between them going to the traditional bank versus some of those B lenders that people aren't really thinking of right now? What do those numbers look like?
Yeah, so as far as rates go?
Yeah, roughly.
So starting with rates, like right now, variable is lower than fixed because of the prime rate going down and all the fun stuff happening with COVID. So right now, a lot of variable rates are like 2.2, fixed is, let's say, 2.5, and that's on the lower end. Traditionally, you're seeing things more like 2.6, 2.7, let's say on the fixed, very common, fixed 5-year, 2.6. Yeah. So yeah, B lender will be, let's say, a 3.6, right, on the low end. Of course, more on average is between 4 and 5%. But let's just say it's, let's say it's 4-ish. So we're looking at 1.2%. So the 1.2%, for some people seems like a lot, some it seems like very little. At the end of the day, you need to put into a fancy mortgage calculator and understand the delta, or what that 1.2 difference does on two main factors: the size of your mortgage, which is of course the price of the house minus your down payment. The more down payment, the less mortgage, right? That's the first factor. And then it's also the amount of time that you have it for. So you've got kind of like, so you've got your down payment, and so you're timing that by, let's say again, 1.2,
Mhm.
and then it's also your amortization period, right?
Right.
So like in the next 5 years, 1.2% over, let's say a $500,000 mortgage. That's going to be a certain amount,
Right.
right? That's going to be the delta. So if you have like a 3.6, you're paying a $500,000 mortgage. You've got a 4.2, let's say, you're paying the same $500,000 mortgage. You have to do the math on what the delta is, that 5-year differential.
Right.
And to the point when we talked about the $40,000, how you can save that across, the life of a mortgage, let's say 25 years. The math behind that is just taking the simple component of like, if you have 1% delta
Mhm.
difference between a prime lender, actually in this example, it's actually non-bank lenders versus banks.
Okay.
And I know I'm kind of getting a little bit off track, but like it's the same point, is that if you have a non-bank lender, they usually have about 0.5 to 1% lower difference than some of the banks,
Right.
right? So if you stretch that across 25 years on like a traditional, not even $500,000 mortgage, $330,000 mortgage,
Mhm.
that delta ends up being $40,000. Again, that's a different topic, but that's actually non-bank lenders that are not known about, and they're A lenders, by the way, and
Mhm.
banks. And then you've got banks versus B lenders, where the banks are like what the non-bank lenders are to the banks, where again they're up by 1%, but also that amount in 5 years, yeah, it can be up to 10K, but keep in mind that the alternative lenders have 1-year terms, usually 1 or 2 year term. So back to the person who can't qualify for a bank, but they see a property that is undervalued, especially during a potential recession, and they really want that property. So they can be like, well, let's say, I don't want to pay $10,000 extra with that 1% delta for now until the next 10 years. I'm going to wait. Meanwhile, they come back in 5 years and now they qualify for a bank, but that property in the last 5 years has gone up by $50,000. So you have to do the math between opportunity cost, appreciation, and how quickly you want to get to market. And then, yeah, like the rate or the number in your head. And what's going to happen in an ideal scenario is you pay, let's take the 10,000 over 5 years divided by 5, 2,000.
Right.
So you're paying $2,000 more for 1 year for a B lender. Then you're leveling up into a prime lender because you've talked to me. We've kind of mapped out your plan. We're okay. You got to get rid of these debts. You got to improve your credit score by this much. You got to make a bit more income. Like what we know exactly how to qualify. We can make a plan. So you take a 1-year journey. You pay $2,000 more. You get your hands on that property. Let's say the property even goes up 5,000 for that period. It goes up 10,000. It's all about opportunity cost, and generally speaking, property goes up, right? Yeah. So it's about getting to market quickly.
Yeah, absolutely. Okay, so I think that's great, because that's something that a lot of especially new buyers struggle with is, they see these tiny differentials in a rate or something. But when you break that down, like your example, say you see the house that you want, the lifestyle that you want to make for yourself now, that would translate essentially to $140 more a month if you went with a different lender that would, approved you today versus a few years down the road. So $140 a month, like, is that worth it to you to get your house now versus later? So that's a really great way to put that into like a tangible, amount to figure out, like, could you save that? Probably. Would you make it back? Almost guaranteed, especially if you're waiting 5 years. That's the traditional wisdom. Be prepared to stay in a house for 5 years. You're probably going to be okay. Nobody ever said, I wish I hadn't invested in real estate, unless they're trying to flip it quickly, which probably should.
Different story, right? They got to talk to you about that. Yeah, exactly. And if you break it down monthly, even there, it's a bit more manageable to think about, like, well, that's just 3 less dinners a month that I go out or 3 less, whatever, right? Like, right. One thing I've been really surprised by is how people aren't very good at saving money. Because a big thing is your down payment, right? Like, so the rule goes, if the property is over $1 million, 20% down payment minimum. If it's under $500,000, it's 5%. But even then, like, people just have pretty dry savings, which is of course a reflection also of, wages aren't the same as Toronto or New York. I get it. It's expensive here. But I feel like, yeah, people could be better at saving, and the more down payment you have, the more accessibility you have for properties. And at the end of the day, you have a smaller mortgage principal, which means you're paying less interest long term. So I think savings is actually just it's in a whole other conversation, but personal finance is really a huge component, just to giving you more options and helping you save more.
Absolutely. So when you're speaking with someone who's sort of new to the game and is considering a purchase, what are some of your kind of like homework assignments that you're giving someone? Our first thing for sure is, where do you want to be and how much do you want to spend? And a lot of times people don't know that first answer, which is major, because I feel like you cannot make a big life decision if you don't know the numbers. And some people have never done a budget before. So what would you say are your kind of recommendations for people to kind of get themselves situated to even evaluate if they're going to make a purchase?
Yeah, 100%. So similar as you, it's like do the simple math around, especially what's your down payment going to be. So starting with your question, how expensive, or how much should the property be? What's the max budget you would hope to shoot for? Okay, now let's see how much down payment you'll need. Again, if it's over half a mil, it's a sliding scale. Over a mil is 20%. Under half a mil is 5%. So let's do the math on, like, for example, $500,000 home, great. 5%, 25K. Do you have that? By the way, you also need to prove to the lender you have 1.5% of the home value, which are equivalent to closing costs. It has to be in your bank. Do you have that? Now, if you're getting a gift from your parents, that's fine, but there has to be a gift letter associated to that. Also, if they're from overseas, your money has to be in your account for at least 30 days, and you have to show a 90-day paper trail because of all the anti-money laundering legislations that are out there, because there's over $1 billion in fraud a year, right, with mortgages. So there's, like, knowing how much money you need to have saved for what is number one. I think it's just the biggest thing. And the thing that it's just most difficult now, and I think it's in many ways, like, it's kind of unfair, I think they're really strict, is, of course, there's a stress test, right? They qualify you off a slightly higher interest rate than what you're actually getting, just to buffer if rates were to go up to 5.04. It's like, I don't see it happening. But anyway, there's a big sort of like benchmark to how you qualify. And to qualify for more, you need to have a great debt to income ratio, meaning less debt, more income. And there's a kind of a nerdy sort of method around that. But basically, you need to maximize your income and minimize your debts. And again, people are very much in debt, right? And that's an issue. Or people make income in a way that they don't track it or they don't declare it. And then the government's like, great. Or the lender's like, great, we're just going to go off what's on your notice of assessment versus what's in your bank statement. Although some lenders will look at your bank statements. That's more the B lenders who are more flexible. And if you can write off money, if you can prove it's in your bank account, and they can be flexible. It will cost you a little bit more. But anyways, like, it just comes down to, down payment, knowing what you can qualify for based off your debt to income ratios. And then from there being like, well, where are the gaps? Okay, how much more money do I have to make? / how much debt do I have to burn? What's my target? And then, of course, you'd hope that the credit score is going to be just fine, but you'd be surprised. Some people, there's little things that can affect your credit score more than you think. And if you're under 680, you're in trouble. So you can go on a site like borrowwell.com. It's not 100% accurate, but it's within 30 points accurate. It's good enough. And it doesn't affect your credit score. Although there's a myth that people say, oh, if I get my credit score pulled by a mortgage broker or by a bank, it's going to ruin it. It ruins it by 1 to 2 points out of 900.
Right.
Nothing.
Right. So you're okay.
And also, if you get it pulled by different lenders in the same period, 45 days, it voids it. So anyways, I think that's just a side myth that just people should be like, it's okay to check your credit. But do the soft pulls until you're ready, and then do a hard pull, and you get a more accurate look. So anyways, I think those are the main things.
Okay. Yeah. Good. So know your credit, which is always important for so many reasons, right? Have a bit of a budget. Know what you owe versus what you have, right? What's your debt? What's your income? How do you look overall? Just kind of your financial temperature. Just take it every 6 months, maybe, right?
Yeah, and down payment's a big thing too, saving for that.
And down payment. Now, are there any lenders out there? Because down payment, I mean, we would love to say, oh, everybody should have their down payment. And it's so, I mean, luckily for us in the Sunshine Coast, there are homes that are 300, 400, 500,000, and so that down payment is 5%, which is still, it feels like a really big, chunk, especially if you're just getting into the market. Right. Are there any lenders that are offering something beyond the mortgage? Like, is there anything to do with lending a down payment? I know that was kind of something that was really taboo before.
Yeah.
Are there any safe ways to look at something like that?
So there is a recent program that came out September 2019. It's the First Time Home Buyers Incentive Program. It's probably the closest thing I can think about, where it's an interesting one. So the government can match your down payment, mainly 5% and 5%. You have 5, they put another 5 in. If it's a new building, they can put in 10 to match your 10. Now that doesn't, that it won't help you get to the minimum threshold you have to get to, because they just match what you have. It's more so the more down payment you have, the less monthly costs, the less you pay per month.
Right.
Right. So people don't want to maximize cash flow in the early days, especially now during COVID. They want to, just conserve cash, have lower mortgage payments, be able to stash away money for other things. This might be a great program for you. Now, I guess the issue, especially long term, if you're not going to sell right away, is that like it's like, I did a blog post and a video on it's like being on Dragon's Den. You have equity, your startup, your company is your house. They invest 5% in the early days, and they kind of take a risk with you. But property is a pretty good startup, and usually goes up. And either if you sell your house or at 25 years, whatever comes first, they take 5% of the new value. So think about how much your property might appreciate in 25 years. They take 5% of that. So it's like an investor. So
wow, yeah.
Long term, I would say don't do it unless you really need it. Is
Right.
my recommendation, but it depends what your priorities are. But that's the closest I can think about. Like lenders, they're not going to help you with your down payment, because that's like the number one test to see how good of a borrower you're going to be. It's like put skin in the game, right? They're even picky about like you can't use your line of credit to then put down payment, because you're putting debt on debt. So it has to be a liquid asset, and people try to get around that, and we do our best to kind of let people know that.
Okay, so that's another really good point for people to know. So it has to be actual cash. It can't be
assets. Yeah.
You can't throw it on 3 visas and say, "Hey, I've got my down payment."
100%. Yeah.
Okay.
Nice.
Yeah, as tempting as that would be.
Yeah. Totally.
Okay.
Yeah. So that's a bit about, from my knowledge, down payment is pretty non-negotiable.
Mm-hmm. Okay. What are your what are your main recommendations when you see people coming in? Like how do you like to coach them? What is your what are you seeing that you say, like, if I could tell people one thing, especially when they're just getting into the market, beyond knowing your finances, knowing your credit score, what can people kind of expect when they're talking to you and saying, "Hey, I want to buy a house. What can I do?"
Yeah, I think the biggest thing is, well, if they're doing it early enough, I'll be like, great, you've done the most important step. You've looked at things early, you know where you stand, and you can work towards a goal, right? So, that's really the biggest thing. I think we talked about, honestly, are the main recommendations. To add on to that, I think it's just about how proactive they are in continuing to check in and get pre-approved. So just to clarify, like, what's a pre-approval? Generally speaking, it's you sending in your documents, giving your income, putting your debts in, and then getting a pre-approval so that I and the lender can roughly tell you how much you qualify for by having looked at your documents and having done all the math and looked at all the fine print that lenders have to see what qualifies. Because some people, they think they're good. They go house shopping, they put a live offer, and then looking at financing, and then they realize they can't get the financing, so they have to let go of the house. Or even worse, some people,
Right.
They remove subjects, right? So they say, yeah, we're going to give you our deposit, we're good for the money, and then they lose money. And that's them being surprised because they left things last minute. They crunched time way too much, and they just weren't thinking straight. And at that point, they're scrambling. Then they're going to maybe a mortgage broker that isn't that vetted, or their first bank that they can think of, and that bank isn't a fit for them. So it's just like being proactive, honestly. But I think the saving strategy is massive. And like, end of the day too, like, it's managing debt. That's such a big one, right? So if you can, like, again, like, have good income, manage your debt, be proactive. And by managing your debt, it means you have a good credit score, presumably, right? Like the world's your oyster. It's not rocket science to buy a home. It's not rocket science, at least from the financing side. In many ways, it's like, just do what you're supposed to do, once you get educated on what it's all about, right? So, because it seems complicated, but it's really not.
Yeah.
I think, and we try to, of course, educate people to really just simplify it and demystify it. And then it comes down to working with people like you, and like you negotiating for people. Time in the market's a super tough thing, right? So I think that's where it gets really strategic. And that's where I say, surround yourself with great professionals, right? On the real estate side, on the real estate lawyer side, like, everyone should be professionals. Yes, everyone, has their commission. Some take it directly from you, some from the lender, some from, the seller's agent, whatever. But it's a small premium for the cost and the headaches and the time you'll waste if you don't do it properly.
Mm-hmm.
So yeah, I think it's really, it's all of the above there.
Yeah.
And talking to people like, like you and me, and just ask, and knowing what questions to ask. And
Knowing what to ask, yeah.
like, and thinking of the worst case scenario,
Mm-hmm.
like what's the worst case scenario here is the minimum I can afford. So you've got a range. When you're going house shopping, like, okay, best case scenario, it's this, don't count on it. So let's go for this. And then minimum, I'll get this, right? So it just, shoot a little bit, have a buffer, because, there's a lot of surprises in the process. So the more you buffer, the better, right?
Yeah, absolutely. It's kind of, it sounds like, just to kind of summarize again, you got to do your homework before you get to do the fun stuff and go out and shop. And that's always what we say too. And I love it because I'm the one who gets to go shopping with them. And it's wonderful. You're looking at the backyards and you're imagining where the kids will sleep and, the neighborhood. And this is also exciting.
And you take them seriously because they have a bid. They have an actual pre-approval. At least it's verbal. Some lenders do written pre-approvals. And you know that you're not wasting your time too, right? And it's actually during COVID is interesting because a lot of showings now have to have consent that they've been pre-approved. They viewed the property. It's like, if you're going to go view the house, put everyone at risk, you better be serious. I think that's a really interesting kind of like other topic around people doing their homework. Now it's forced because you can't afford to just be looky-loo, right?
Mm-hmm. Yeah, I think everybody, they do. They take the whole process very seriously. They don't want to put themselves at risk, and if they're in the market, I think you are definitely you've done some research, but it's the first thing we tell people too. I'm so glad you called us. Mm-hmm. Have you done your homework? Do you know your numbers? And that's for you because, like you said, you don't want to be scrambling last minute. You don't want to be forced to make a decision you don't want to make in terms of the lender or anything to do with that. So that's where you can lose the money. It sounds like those last minute decisions, right?
Yeah.
Not having a strategy can lose you $40,000 over a lifetime, and that can be a big deal. So it's like, do your boring homework up front, and then you're in a great position, and you've saved yourself some money and less stress. Like
totally. And you just reminded me of another example where the $40,000 can actually, in this case, hurt. Bank penalties, breaking your mortgage. So banks usually have 3x, 3 times more. 3 times bigger mortgage penalties than non-bank lenders, which again, I didn't explain that a whole lot before, but I kind of covered it. But yeah, there's a whole bunch of like what are called monoline lenders. So they're like people like RMG, MCAP, First National Equitable Bank, that not all of them have retail locations. In fact, most of them don't. But all they do is focus on mortgages. And they're actually funded by the big banks. So they're super legit. They've got millions of dollars, but since no one knows about them, they have lower rates. And also they've got, I think, much more generous conditions. And one of them is a lower mortgage penalty. So usually they'll charge between 0.8 and 1.2% of your total mortgage will be the breakage penalty. If you break a penalty because, God forbid, you get divorced, you sell your house, you move out of province. Some people don't let you move out of province. You want to get a lower rate, so you got to break your mortgage. You want to refinance and get equity out of your house. All those things, generally speaking, break your mortgage. And like we've seen penalties up to $40,000. Like it's out of their pocket. Oh my God. 40,000. That's going to be with a bigger bank. And yeah, that can add up. And like suddenly, even if the bank had a great rate, like whatever, let's say 2.6, the effective rate after $40,000, you're paying like 5.5, like 6%, right? So basically, don't rate shop. Look at the other fine print of the mortgage, and especially too, like if your strategy, like actually, this is the biggest thing I ask people. This is the first question I ask them. Remember, it's all coming back. First thing is your goal to save money over time or get cash flow up front? There's no right or wrong answer, right? Cash flow up front, I'm saving for, my kid's university. I lost my job. I need security. I need cash, or I'm being really risky and putting in the stock market, whatever. Okay, great. Well, there's a lot of cashback products for that at higher rates, mind you.
Sure.
Right? So anyways, so there's that strategy. And then there's a strategy of, and of course, you can also extend your period in your mortgage from 25 to 30 years, which means you pay less per month because it's stretched over a longer period of time. But the interest is compounding over longer, so you're paying more long term. So there's sort of like that. But if you want to save the most money long term, which of course I recommend if that's something that you can afford, it means, yeah, of course, a low rate, but also it's mainly a low cost of borrowing, meaning that when you look at your low rate, you de-risking yourself from getting a mortgage penalty, which is $40,000, and maybe instead it's $5,000 or $10,000, And also you can pay off your mortgage a little bit faster with what's called, a prepayment privilege, right? A lump sum or a monthly amount. If that's part of your plan, because you're going to make more income sooner, you have an inheritance coming and you pay off your mortgage faster, you can very quickly save more money over time. Plus, making a product that's robust, it lets you pay things off quicker, and it just has certain features that are either going to hurt you less or they'll give you the advantage to get ahead of your mortgage. Those are really big things. And again, it comes down to saving cash, saving money long term. I hope you're in the other boat, and if so, ask more questions than what's the lowest rate.
Such good advice. Yes. Okay. I've taken up a ton of your time, but this has been super helpful. We'll have more on our blog when we sort of like.
Totally. Yeah. You have a lot to transcribe here. Sorry.
Written word. Do you want to give our millions of viewers a last minute, like parting little bit of advice, how to get in touch with you when they're ready to go?
Of course. Sure. I mean, look, end of the day, don't be intimidated by the process. It is a journey. It's one of these dreams we have to own a house, white picket fence, all of that. It's very accessible. There's a lot of education around it. As we said, obviously plan ahead, be around professionals. And think of it as a personal development journey where you're being forced to be better at finances, be more aware of how credit scores work, which honestly, before I got into the business, I didn't really know how they worked, right? And it just forces you to kind of grow up and be better. And that kind of segues into our name, Level Up. It's all about leveling up, right? Being at your best. And this is definitely a really good challenge for you to get there. And you can start it early. It's almost like in psychology, they say that a lot of times you get more utility, you get more value from a vacation when you're talking about going on the vacation than actually being on there.
Yes.
You can make a parallel. It's the journey of getting towards getting that mortgage or getting that home, of course, that makes you a better person. And I think you'll get more utility from them when you actually get it. So think about the journey. Rather than the destination, of course. So the destination, of course, is important. And yeah, parting words. Look us up on YouTube. We've got a weekly show. We do interviews much like this. I do one-on-one kind of like battle stories of like cases that have gone wrong in the industry that I don't want to happen to you. So I give a lot of case studies. And yeah, I have a lot of like how-tos and just explainer videos on doing a lot of self-education. If you want to talk to me, sure. If you want to go online, go on the site, go on the YouTube channel, follow us on Instagram. It's just all Level Up Mortgages. You can look us up. I'll send you some stuff for the blog and the show notes, and love to get in touch. And good luck with things. And I'm glad they made it to the end of the interview.
Well, thank you so much for taking the time today. And so I'll say goodnight. Paul Davidescu, Level Up Mortgages. Thank you so much. We'll be talking again very soon, I'm sure.
Definitely. My pleasure, Nicole. Thank you so much, and take care.
Have a good one.
You too. Bye.